You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That rockin' tune means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, ever-scintillating Options Insider Radio Network. Quite a few programs for you guys to choose from, including well over 100 archived episodes of this fine program, Volatility Views, for you guys to join and enjoy, really, at your leisure. So if you're just joining us for the first time, you're saying, what is this Volatility Views stuff? Well, of course, you got a lot of great back episodes, interviews, discussions, debates to enjoy. Best place to do that, of course, the mothership, the flagship, theoptionsinsider.com. And, of course, also via all of our regular outlets, including iTunes and TuneIn and Stitcher, so on and so forth. You can find us either via the radio network feed, the major feed, or, of course, just search for Volatility Views and subscribe to that there. And while you're doing that in those shows, in those stores, I should say, if you want to leave a review, 5 stars if you like. If not, if you don't like Russell, I understand. Want to knock it down to 4. I understand. Whatever floats your boat. But we don't always ask for those, but it might be kind of fun to see what you guys think in those stores as well. Just don't use it for your immediate feedback on the shows in terms of questions, because we don't get to those very often. If you want to send questions, hit us up the old-fashioned way on Twitter, on Facebook, on the website, via email, or, of course, if you're streaming live via Mixlr, MIXLR, we stream the show live every Friday, noon Central, 1 p.m. Eastern. So grab the link over there on Mixlr. Just follow us on social media. We tweet it out before the show as well. And if you're around middle of the day on Friday, we'd love to see you. And speaking of seeing, we don't see him, at least not this week. He's not in studio. But we do hear from him occasionally. And he is Mr. Russell Rhodes, the senior instructor over there at the Options Institute of the CBOE. Mr. Rhodes, welcome back to the Volatility Views program.
Hey, can you hear me now?
I can indeed hear you now. How you doing?
Awesome. Using a brand new computer and a brand new internet hookup and newly installed software. So I'm hoping that I'm coming through crystal clear. And if you hear a little bit of noise in the background, there's an awful lot going on in the VIX pit that's about 30 feet away from my sort of corner office. There's 4 corners in my office, but it's not a corner office.
Things are actually cooking in the VIX pit today? Things are slinging, moving?
Yeah, they are. Tons of fun.
If you hear that tinny voice, listeners, it means I've been joined mid-show by an intruder here in the studio. Yes, we are joined by the greasy meatball himself, Mr. Mark Sebastian. Mark, say hello to the fine folks out there.
Good to be here. What a day, huh? A little bit of. We were waiting for that more than 1% move the last few weeks. Finally got it, and boy, did we get it. And I know we'll talk more about the volatility review here, but I've been writing a weekly vol summary on Mondays for Tullett Prebon, which is a pretty large international broker. And my title of my last piece that I wrote was "The Fed is Vol." And if you look around, tossing out the Brexit, give me a vol event that hasn't been Fed induced since really August of last year. And really, even part of August last year, I'd blame on the Fed.
Yeah, just reading, I forgot where I was reading it. They were throwing some data points on the market. They were saying we haven't had the proverbial 1% move to the downside, particularly in an extended period of time. I forgot the exact length they quoted, but it was some historical measure. And then sure enough, I was about to bring it up on the show today, and then lo and behold, we get one today anyway. Since we're talking about it anyway, let's just keep on rolling and dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. As the name implies, this is indeed the portion of the show where Greasy Meatball crashes the studio and everyone has fun.
I told you guys I was coming, right?
I don't recall, but hey,
No,
we're always available.
idea.
We're always available for surprise guests here on the studio. That's not open to the public listeners, so don't come crashing it.
Yes.
But of course, we should probably do some studio audience every now and then here in the show.
Win a chance to attend live.
Yes, we're in it. You can drink the beer before the greasy meatball gets to it.
Speaking of which,
that's a good challenge. It's early even for you, but if you want to have at it,
it is afternoon.
That's true. It is literally afternoon now. And as we are saying, it is right middle of the day here, middle of the session here on Friday, September 9th, for all of you joining us live, as well as for all of you playing along on the old home version. And as the Greasy Meatball was alluding to, we are getting a wee bit of a sell-off. This is one of the reasons why we don't like to do the show notes for the show too early, because things change on a whim. And as Mr. Rhodes was alluding to, things are lightening it up in the VIX pit today. VIX Cash up nearly 3 handles as we're talking here, hovering the mid-15 range. So all of us who were fading VIX like crazy last week and saying it was going to be, myself included, in the 11 handle range yet again, we were surprised as this downside move coming in. The S&P off about 1.5% as we're recording this. The Q's off a wee bit more, 1.6%. The Dow a little bit of a laggard, about 1.3%. But still red on the screen all over the place. Mr. Rhodes, you were saying things were lighting it up in the VIX pits. Maybe we'll start with you. What is catching your eye out there, and what, if you've seen anything going on so far, what's been lighting it up out there today?
Well, I'm kind of surprised with and it's not necessarily a lighten it up thing. It's what doesn't seem to be lightening it up. And I'm kind of surprised with the VIX that we're getting out of, or the move that we're getting out of VIX, to put the words in the proper order there, that we're not seeing a little bit more out of the futures. Because the talk amongst those of us that talk about VIX has been the extreme level of short interest among leveraged players. And I think there was this feeling that when VIX moved, we would get an accentuated move out of the futures. Maybe they haven't reached the threshold of pain quite yet, those speculators that are short the VIX futures. So I'm a little surprised that we just shifted right into backwardation very, very quickly, which leads me to believe that some people think this is just a short-term blip like we've seen for the last half a decade or so.
We had some room to run on that. The futures were a little elevated. Now we're finally catching up. That was going to be one of our talking points on the show today. That people were still asking about why particularly the ACK and beyond range, NOV, and that range seemed to be so elevated. catching up a wee bit today, I think you could say out here today. As we're looking right now, actually, we're saying VIX has been averaging right around that 600,000 contracts a day level out there. In the options already so far, only halfway through the session, hitting about 5.25 million. So 500 million, obviously, in a quarter. So things are rocking and rolling. You were right out there, Mr. Corner Office, about 3-to-1 calls over puts, which is actually light for a VIX day, particularly when it's up 3 handles, or as Mr. Sebastian loves to quote, 23.6%.
Come on.
I gotta throw out a percent of a percent just to make your day. But Mr. Greasy Meatball, aside from running your way over here and cleaning out our mini fridge, what caught your eye in today's activity?
Yeah, I think that the move in VIX is not exactly surprising, given that this is a big breakout, and I guess we have a surprise Fed governor on Monday speaking around noon Central Time, 1 Eastern. And one of the reasons why vol is maybe up and money's coming off the table is the belief is if the Fed is going to try and raise rates in September, she's going to come out and be extremely hawkish. That's from our boys, the Thompson boys. Gave me that little tidbit.
The Thompson twins.
The Thompson twins, at Dynamic Vol and at Mike T 1240, whatever his one is. Yeah, how is it that Matt's got such a cool handle, and then Mike Thompson has such an old man that just signed up for Twitter handle?
I think you hit it on the head right there, sir. What is this? Them are tweets. How do I use this?
So then, so I think that's an interesting thing. Yeah, and to Russell's point, we'd had such outside of September, which expires in about 8 days, we'd had such a big cushion in October and November that I'm not surprised. I mean, October was leading into today, still well above 15. It's currently trading over 17 now, so tons of cushion in October. And the November was 17.5 and is now over 18. Tons of cushion there. So September aside, there's just so much. There's such a kind of an underneath bid, so much curvature in those VIX futures that I'm not surprised that the futures other than the September aren't doing much. Now September, on the other hand, is moving a lot like VIX. You got the VIX up $2.80. Well, actually, right now, as I'm looking at it, VIX Mo's up 3, and that SEP futures up 210. So catching about, call it 65% of the move. That's not bad for an 8 or 9 day option. And the VIX future that expires next Wednesday, if you really want to look, if you want to trade VIX and you really want to track VIX for the next 3 days, then by all means, go after the VIX future that expires on September 14th. That is tracking VIX Cash real well. That future is trading about 1570, so it is right on top of the underlying. So that's what I'd be looking at.
Mr. Rose, I know something's burning you up in the corner office, sir. Anything interesting to add to what Mark was just saying? I think you two on the same page.
It's not Mark's weekly rundown.
He's pissed you're jumping all over his segment. I see.
You're jumping on
I'm just talking
segment.
futures. I didn't do any options.
He's just jealous he doesn't have his own segment.
I was going to point out that if you think this thing's going to follow through after the weekend, which every once in a while we've had Friday moves that nobody has that nobody can pinpoint exactly what the heck's going on. Saying that this is a move in front of something that people are going to say on Monday leads me to wonder if there's something else going on in the world that we're not aware of. We had funny action like this about 54 weeks ago on the Friday before the I'm not saying this is what's going to happen, but the Friday before we got a bunch of news out of China and came in and the S&P futures were down almost 10%. But sometimes there's a little bit of that going on as well. I did want to point out that the CME's Fed tool yesterday it went out saying that there was about a 50-50 chance that we would have higher rates by December, and those odds have gone up to 60-40 that we're going to see higher rates by December. So I do think there's a rate component to what's going on.
It's nice that the CME, that the SIBO's Fed tool could quote the CME's Fed tool.
Well,
This is why he doesn't have his own segment on the show.
That's called Mark's weekly pot shot at Russell.
He only does it when you're not in the room, Russell. He doesn't do it when he's in the corner office.
I was gonna say he's taking advantage of the buffer right now, isn't he? So.
That far buffer here in the old studios. But you're right. It would be kind of surprising today if we saw such an elevation in the cash and the futures also moved commensurately. That would be, things would be super crazy then, because they were already fairly rich. Like I said, we were going to talk about that coming into today's show. You were right. The Nov and D's future were extremely rich compared to the cash. A lot of our listeners, they've been talking about that last couple of weeks, and they've been still kind of writing into us saying, what's up with that? Now at least we got a little bit of catch up. So maybe that curve attempting to flatten out somewhat will ease some of their concerns. We've also been talking for a while here. It was kind of our running joke on the show for at least the last 3 weeks that when we were prepping for the show, you could pretty much just cut and paste VVIX. It literally had not moved. It was at 85 every Friday for every week we've been doing this. And today, of course, gapping up a wee bit back over that 100 level that everyone likes to pay attention to, that sentimental, psychological level of 100 out there. Was hitting 85 this morning. Now, of course, back over 100 again. That's still not extremely elevated compared to where it's been just back in June. It was printing around the 130 level. So that's probably middle of the range, but it's no longer hovering right around the 85 or so area, which is not that far off the lows it's printed for the last year or so, which is somewhere around that 75 level. So VVIX a little bit elevated, obviously, as we're finally getting a little bit of love back in the market from a vol perspective, getting a little bit of realized vol as well, because as we were saying on recent shows, HVol was kind of nowhere to be found. It was hovering around 5 even coming into this morning. So things weren't exactly lighting it up from a historical vol perspective as well. But nice to see we're getting a little bit of a sell-off here today. Just gets to get some juice back in the old market. I don't know about you, Russell, but I was getting tired of predicting a VIX somewhere in the 11 and the endless will they, won't they dance below. Will it break the 11 handle into the 10 handle? So we'll see. But, of course, we had a truncated trading week. We were going to say it was kind of a light week. And then, of course, today lighten things up. Speaking of lighten things up, Mr. Rhodes, I know you've been watching the VIX pit. So let's get right to it, right into Russell's weekly rundown.
Now, Russell's weekly rundown.
All right, everybody. Like the man said, this is the portion of the show where Mr. Rhodes takes over for about 35 or so minutes and regales us with the detailed minutia of trade by trade in the VIX weekly option. So have at it, sir. The clock is ticking.
Hey, it is a pretty extensive. It is a pretty complete coverage of what's going on in the weekly.
Then maybe I'll go.
You got to admit that
it is pretty good. I'll go raid the fridge then with Sebastian while you're doing this. Then I'll be back in like 20 minutes.
Mark, stop drinking beer.
That's a joke that 3 people will laugh at, including me.
I'm finding the video right now and getting ready to put it out there. So in the VIX weeklies, there's one trade that I really find pretty darn interesting. Somebody thinks this thing is following through, and they came in and they bought a bunch of the September 14th 16 calls for 55 cents and sold the 19 calls for 22 cents. This has got to be an opening transaction because the open interest does not cover what's going on here unless somebody covered a short and is doubling down to the upside. But either way, it's a pretty darn bullish trade. We're seeing a little bit of, extra activity in the 21 calls that expire next week as well. But the open interest was already about 3,000 contracts there, and the volume's only about 1,000. It seems like, and I know I'm going off the, going outside of the parameters of the intro music, but it seems like, if anything, this activity is causing some stuff to happen out in the October options. That people think that maybe this is the first sign of some extra volatility. So that you mentioned that we're over 500,000 contracts at lunchtime today. As always, it's concentrated in the standard expirations, but it really looks like, a lot of activity out to October already, even though we've got the September expiration about a week and a half off. So I think people, even though the futures aren't necessarily following through as much as some people would like, either people are taking advantage of the ability to still get some long volatility positions on before we really get a move to the upside, or they just believe this is the beginning of a very volatile fall. Needless to say, working at CBO, I'm rooting for them to be right on that one.
Yeah, that wouldn't be a bad little shot in the arm for you guys over there to get a little bit of juice back in the old marketplace. You're right here. I'm looking here. I just pulled up hot, fresh action from today's VIX pit, and you're right, Ak. It is active. It seems like 15,000 lots are the order of the day, kind of across the board, no matter where you're looking. But it looks like Ak vertical 1722 coming up. Also, SEP still active. 1621 seems to be trading pretty actively. 15,000 of those bad boys going up as well. And we have so much paper like you have in a day like today. There's a lot of needles in that there haystack. I don't know, Mark. I know you've been paying attention a little bit to what's been lighting it up out there. Before I get into the rest of the week, anything catching your eye really in today's VIX options activity worthy of note over there in the land known as Carmen Line?
Well, here at Carmen Line, we actually we got out of the way on Wednesday. We closed all our short vol Wednesday.
That's why you look so relaxed.
That is why I look so relaxed. We've got it like we own some baby puts delta neutral. And we intend to
What fun is that? Baby puts delta neutral. That's no fun.
Well, the thing
go big or go home.
The thing about buying baby puts delta neutral is that on a rally, the baby puts hold their bid, and then you unwind the future when you think we're at the top, and then when we sell off, that's when you can really catch something from there. Big trades I saw today. I saw a few. There was lots of buyers. A big buyer, the 2230 call spread, a big buyer of like the 2030 call spread. We also saw the SEP 14 put versus the OC 2030 call spread. There has been a lot of that. I've also seen some pretty big put trades going up, both bought and sold. Big buyer of the SEP 13-14 put spread went up. I thought about selling them, some did not. So the only real trade we've done at Carmen Line today was to cover the short side of a put spread.
Yeah, tight put spreads have kind of been lighting it up a bit as well on today, and not just today, but throughout the week. And we did see a lot of verticals going up again, also with put components. So put kickers, if you will, coming out there. Sometimes just additional put legs, as in the case of yesterday on Thursday. Fairly light day, about 324,000 contract. We're already almost 2x that today, and we certainly will be by the end of the day. We saw yesterday the DEES verticals, so DEES lightened it up a little bit yesterday, which is kind of interesting. The 1823, again, getting back into the old 1x2 range, doing it 11,000 by 28,000, so over 1x2. 11,000 on the 18s, obviously 28.5 on the 23. So the 1x2 extending all the way out to DEES now. We were talking NOV on recent episodes. Now DEES apparently is now lining up for the 1x2. At least it was yesterday. We'll see how those futures are making that look today. Also with this, though, this time, a lot of times we've seen these financed by puts. This time it seemed like the puts were in addition, about 10,000 of the 18 puts in December also going up as well. So our friend here banking on some big moves away from the 18 strike in either direction. He's not really particular, probably will be leaning to the upside, but got the puts on just in case as well. Also saw, like Mark was referring to earlier, relatively tight put spreads also going up yesterday and today. Yesterday we saw about 8,000 of the SEP 14-12 half put spread, so 1.5 going up there. And then earlier in the week we had some earlier fairly active days, like Wednesday, about 500, nearly 600,000 contracts going up on Wednesday. So a fairly active day out there as well. And upside calls were all the rage on Wednesday, including about 50,000 of the SEP 20s going up. It looks like probably closing there for 13 cents, as well as about 20,000 of the OC 26s. So of that nearly 600,000 contracts, nearly 70,000 coming in those two prints alone. People just gobbling up themselves. Some upside we also did see. Speaking of upside, we did see, looks like a short, pretty wide vertical. It was the OC 20 32 half going up. Paper selling that 20,000 times for looks like about 69 cents over there. So we always joke about some of the verticals being a little bit wider up here in VIX land. That's a pretty wide one, 12 and a half handles in October. So interesting stuff. And then Tuesday, to kick off the week, again, it was a truncated week here in the States with the holiday week. It was yet another upside call palooza with some fairly aggressive upside lighting it up in October and September. The OCT 27s going up 25,000 times, the SEP 21s, OCT 32 halves again. So that vertical, that 32 half strike again, lighting it up on Tuesday, as well as, of course, the SEP 16s, a little bit more realistic with about 14,000 of those bad boys. And of course, Monday, no action because the market was closed. Looking at what are the hot strikes for this week out there in VIX land where people are actually printing and trading, and not the 30s anymore. They've moved away from the 30s. Of course, today, like today, the 30s become a little bit more relevant. But it was the SEP 21s leading the charge with about 272,000 contracts, followed by the SEP 25s, 262,000. Then all the way down to number 3 to find our first put on the list. The SEP 13 puts, about 250,000 even open of those bad boys, followed by almost similar numbers of the SEP 20s, about 250,000 there. Then we drop off a little bit again to the SEP 19s, all SEP all the time, 225,000 open of those. Number 6, the SEP 18s, 221. Pretty much, yeah, the rest of it is all SEP puts, SEP calls, except for one. SEP 22s and SEP 17s, both around 200,000 contracts. And then the SEP 24 is at number 9 with 187. And all the way down at the bottom, the SEP 14 puts, the aforementioned SEP 14 puts, with about 182,000 contracts open. I know, Mark, you were talking about those, saying those puts have been lighting it up. And all in all, about 7.5 million contracts outstanding, about 5.3 on the calls, about 2.2 on the puts. Anything else, Russell or Mark, here on the VIX options side before we roll on to some other things, maybe crude vol really quickly? Then I do want to get to some questions because I know Russell was even saying we had a guest last week. Didn't have time to get to the questions. We want to make sure we get some on this show.
I just want to briefly say, how about VVIX being up 18 handles to almost 104? That is just if there's one thing we've learned in the last, at least from the pattern the market's traded, VIX has kind of gone where it's wanted to go. It's gone lower than we thought it could go and higher than we thought it could go. When VVIX has gotten to 80, vol premium's been too cheap. And that is what we just saw. So I think if you see VVIX, when I see VVIX threaten that 80 level, I become a buyer. That is the time where those back spreads that everybody likes look really good. Now that we're about to make a run at 110, don't be surprised if Monday before this Fed speaker speaks, we don't see the 25-30 1x2 long 1 short 2 trade for some bulk or some different things like that in October.
Long one going the other way.
Long one, short 2.
But you're right. We were talking about earlier in the show about VVIX finally breaking out of that kind of, can't really call it a range. It's kind of just been hovering right at 85 for the better part of the last month.
That has been the line. When it gets anywhere near 80, that premium has been a steal. It's worked. It can go lower. It just is not right now.
Yeah, it certainly can. And we're seeing today, of course, it finally getting back above that critical 100 level. Speaking of things that are actually moving today, we've been talking a lot about crude volatility. That's also kind of been in the toilet for the better part of the last month or so. OIV and OVX, of course, our favorite crude VIXs, OIV for the WTI products, OVX for the USO. A lot of you guys like to sling out there as well. Both of them have been hovering in that 38 range. In fact, I'm going to turn the screen so Mark can't cheat. And we did ask our question of the week. Actually, it came out before the show. We asked people out there, including you guys, who can still vote. It goes on for a couple more days, I believe. Our question of the week this week is we asked you the crude oil VIXs, both of them, OIV and OVX, were both hovering around 38, both near 52-week lows at the time. We asked you where will they close next week, so next Friday. Also, already got the votes coming in. We'll start with you. Russell, because you're all the way in the corner office. I know you can't cheat unless you have your computer screen up for Twitter, in which case you are cheating. But what is your vote, and what do you think is winning our poll?
Between oil and gold.
I should probably give you the choices, shouldn't I? I asked you where will it close? Where will OIV and OVX close next week? We gave you between 38 and 40, between 36 and 38, above 40, or below 36. So have at it, sir.
Above 40.
That's your vote, and that's also what you think is winning the poll?
Yeah. People that vote, they're all about the high volatility.
Mr. Greasy Meatball, what are you feeling in this poll, sir?
All right. So what are my options again?
Between 38 and 40, between 36 and 38, above 40 and below 36.
It is above 40 is winning for sure, and I don't think it'll settle there next week. I would take the 36 to 38 level.
So right now the winner actually is below 36. So people are selling themselves. People
That's
are selling.
not sellers.
People are selling
That's
themselves.
not true. I just voted, and now above 40 is tied with below 36.
Oh, okay, yeah. Well, the poll did just start, so give it some time. So Russell is not only is he cheating and looking at the answers, but he's also trying to manipulate them.
I'm going to cheat too.
So we're going to
Chicago!
vote early, vote often. So we're going to mute him for a little bit of brief punishment
36
there.
to 38.
Now the numbers. All right, there we go. I got that with both of you. You're manipulating the numbers left, right, and center. I should cut off all connection here in the studio. But at the time,
we could just call this the Citadel views.
Yeah, there we go. But at the time, before this manipulation started happening, listeners, below 36 was winning with about 40% of the vote. We'll see. The poll just started, so we still have a few days, and you guys can still vote.
Right?
Yes, we've been seeing, of course, as we move continuously. There was that rally, then of course the sell-off again today out here in crude, as we're there's this endless debate whether the stocks dropping is real or if it's just hurricane-induced and it's going to come back right up. All the people out there in that Asian crude conference were leaning on the latter, saying crude's going to come back down, and crude, of course, giving up some of those gains today. And, of course, whenever we retreat back into the put ring out there in crude land, whether it's USO, whether it's WTI, I don't care how you trade it, the puts are where the action is from a vol perspective, so we tend to see vol increasing. So if we do sell off again next week, we should see OIV and OVX both commensurately moving north of that 40 handle. So we'll see as we keep on rolling. And it's about halfway through the show. We didn't get a chance to get your questions last week, listeners. So we're going to do a bit of an extended volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. This is, of course, the portion of the program where you guys get to take the reins with your questions, your comments, your insights, not just for me, but for your fellow Volatility Views listeners as well. And we're going to kick things off. We got a lot of questions been piling up for the last few weeks. By the way, if you guys are streaming live or you listen, and even if you're not have a Mixlr account, hit us up on Twitter or on Stock Twits or the usual outlets, and we'll see if we can rotate you onto the show as well as we're fighting through our mountain of our backlog of questions. This one starts off. Let's start off with Joshua Shealy. I think I'm pronouncing that correctly. He says, "Thanks so much for all that you guys do." Well, you're welcome, Joshua. He says, "Sorry if this is a novice question. I know that delta is not literally the percent chance of expiring in the money, but more so the rate of change for a $1 movement in the underlying." Well, you're correct there, Joshua. He goes on to say, "I noticed today," and he wrote this a couple weeks ago, shows how big our backlog is, on August 26th, looking at the VIX Dec Calls, that the strike closest to 50 delta was the 20 strike, which he says at least was a long way from at the money. I usually associate near 50 delta with being near at the money. Is this just the nuance of VIX, or am I missing something bigger?" Thanks. Good question, Joshua. You are missing something bigger. It's called the VIX Futures Term Structure. I wish I had a print from August 26th. I could see exactly how it was shaping up. But even as of this morning, it was fairly obvious. The VIX Cash was right around 12.5, and those Dec to Jan futures, the Dec was 17.5, the Jan was 19. At the time of August, I think it was even more rich. It was hovering around 20.
You need to create an auto reply that just says, "This may answer your question. Take a look at VIX term structure."
Yes, we have had a few of those questions. But
thanks for your interest in Option Insider. Your question may be answered by the following. Take a look at VIX term structure.
You're probably not that far off. You probably could do that. We do get a lot of those questions, but this is a different way of asking the old question of VIX Cash is here. Why are the options printing at some different price? Isn't there some crazy discrepancy? And the answer is always with that is that they don't key off the VIX Cash. Obviously, they key off whatever associated future. And your future you were looking at for those VIX options was right around the time close to 20. It was about 19, I think 19.5 or so at the time. So therefore, just by sheer volume of where the future was, your at the money strike wasn't in the 12 or so range where you're looking at the VIX Cash, but actually at around that 20 level. So your eyes did not deceive you. You were correct that the at the money for your future, again, the VIX Cash is just, we said it many times, it's useful, it's informative, but it's not what you should be keying off of for your trading. You need to look at where you're thinking your trading is going to happen and then look at the futures in that time range, because as we've said many times on this show, just in the last couple of weeks, the farther out you got in that VIX futures term structure, the richer and more expensive things got out there. I don't know, Mr. Rhodes, you teach this stuff on a daily basis over there. In fact, you have a class going on today. Anything you want to add to our friend here, Mr. Joshua, who's learning about VIX, clearly working out how that term structure impacts the options?
Nothing to really add to what you guys said, other than in the next 30 seconds, I'm going to tweet a picture of the term structure from 826.
I knew we had you on the show for a reason, and it was your instant access to all data, sir, which is handy. But as I recall, I remember when this question came in, I looked it up, and I think it was right around that. They were like 19.5 or so, those futures. So it was clear that it was. I mean, obviously the pricing is that way, but just to explain it to him in more clear terms, that clearly is. And also, he's very advanced for a novice. He understands that delta is not the probability of expiring in the money. That's a common conflation. We had that debate years ago here on the show with our old friend Don Schlesinger. We had some great mathematical treatises on the subject. I encourage you, if you're really deep into that stuff and the Greeks, go check out some of those early episodes. Maybe we'll post a link in the show notes so you guys can see it for yourself.
That argument with that skew, the guy about skew.
Oh, that's a different topic. But yeah, the guy who wanted you to, I think, to sell all puts or something. He wanted to just buy puts all the time. Yeah. And because that works.
Yeah, that works. And he said, no, skew doesn't exist because of supply and demand. It exists for...
Oh, yes. Now it's coming back to me.
Okay, pal.
That's why we have academics on the show once in a while, but not all the time, because they say...
We've got our quasi-academic Doctor less dissertation VIX.
He's our aspiring academic. That's as close as we want to get. All right, so good questions here. A good question here, Josh. Let's move on to one here. This is a lengthy one. All right, let's see how much we can get to this. This is from Dr. Larry. By the way, he's angry at you, Mark. He says, tell Sebastian never returned my call. So apparently you're making friends. This person, Dr. Larry, he writes, hi, Mark. Andrew mentioned buying stocks and buying covered long-term puts when implied vol is so low. I wonder your opinion on my favorite low vol strategy. He wants to buy ETFs, preferably non-correlated underlyings with some dividends. He gives examples of DIA, SPY, GLD, etc.
Everything correlates.
Everything. Yeah, well, that one. Yeah.
And strike number one: buying equities.
Yeah, but they do tend to move to one when it hits the fan. That's a conversation for another day.
Keep going.
This question is long enough without you chiming in, sir. All right. Then he goes, I then buy the longest dated leaps available, with strikes 5% under current price of underlying. So he goes way out. I then sell covered calls every 30 to 60 days that are 1 to 2 strikes or 3 to 5% or more out of the money. Then he lists his management. I'll run through these quickly. His ETF stays the same. He rolls the short calls up. If it goes up a little, he rolls the short calls up and out. If it goes up a lot, he gets called away and reestablishes, and he rolls his leap up. That's a crucial part, rolling the leap up. I want to get back to that in a minute. ETF goes down a little, roll the short calls down or same strike, assuming it's above the leap strike. If it goes down a lot, he takes his profit on the leap. Again, we'll get back to that. Reestablish lower strike leap, roll it down. 1 year later, he rolls it. This sounds a lot like our friends on the advisors option.
Yeah, I was about to say, this sounds like
the Swan friends who do a similar approach to this. They go out about 2 years. I think our friend
well, that's what he wants to do. They're out, but they set it at the money, not out of the money, and they sell the put and the call. But it's not it does sound very similar.
Not entirely dissimilar. They have a couple extra legs. But and then they do roll 1 year out. I think for a similar reason. He apologizes for the long email. That's all right. I hope you can discuss on air. He says he does the long leap because he more for the theta perspective, which is why the Swan guys do it.
Tell him that I never got his phone call. If he'd like to shoot me an email, marketoptionpit.com.
He's Dr. Larry in New York.
Tell him Dr. Larry in New York. Oh, is that? Oh, that might. I know who that is. Tell him I need to give him. Tell him I'm happy to give him a call back.
Okay.
I didn't know that he called.
Apparently he's calling you, and you're not picking up.
He's an excellent doctor, and he's also an excellent trader.
Oh, there you go. High praise from the Greasy Meatball. But this is kind of an issue you and I have discussed before. Russell, I'd like to get your thoughts on it as well. Some people do this. I've discussed it with the Swan guys as well. I'm not convinced of the efficacy of the leap component of that. You go out 2+ years. I understand the theta argument, why you want to do it, and that seems to be the predominant reason people do it, but you're paying a boatload for that protection on whatever strike you're choosing, 2 to 3x sometimes what you would be if you were a lot closer. And then also, you're not getting a lot of bang for your buck. As our friend mentioned here about delta before. Remember, the farther you go out in time, the lower that delta is.
Well, and I think an important thing is with Dodd-Frank, skew in the leaps has gone up and up and up and up. I would, I like the system. I would actually tweak it a little bit, maybe put on all those different equities. What about using, to kind of use a theta capture to maybe steal an idea from the Swan guys? I like the covered call idea, but what about doing like a bear calendar where you're long, maybe like the regular 2018 instead of, or something next year, and you're rolling short a calendar spread out of the money, 5% out of the money. That calendar spread is going to do all sorts of good work for you, 5% out of the money. If you sell some puts against it, it's not a bad idea.
And he mentioned adjusting the leap too. That's another part. I mean, that leap, you're buying it so far out. It means you have to choose your strike now for effectively 2 years from now. How useful is that going to be in a week, let alone 2 years? Like today, we're off 1.5%. All those strikes are going to change. Yeah. You have to roll. It's going to be spend a lot of money to adjust that leap.
And I would say that he could save himself a boatload of dough by hedging off his ETF risk just using like a big index over it. So maybe do all those ETFs and then hedge using SPX. Now, an alternative would be these VIX back spreads. The positive, you get the sticky strike. The negative, you get not a true guaranteed correlation in protection. But I would point Dr. Larry, one of the best podiatrists in all of New York, as to take a look at taking the correlation of his ETF basket and that to the S&P 500 and then running SPX options underneath using bear calendar spreads and then writing covered calls against it.
I like the calendar idea. The VIX one is interesting. I like maybe rolling that that leap in a little bit. I know the 1 year threshold for decay. I understand that, but maybe you do a year to 6 months and see if that is you'll save money on the outlay. You'll get a little bit more bang for your buck in terms of actual hedging efficacy on that put. A 2+ year put is almost, I wouldn't say it's useless, but it's not exactly going to save you on a catastrophe days unless it's really, really melting down versus like a regular 1 or 2% sell off.
You need a system.
Yeah, you need a systemic. You need to really have something it really needs to hit the fan for that put to any other scenario. It's not really going to be terribly effective. That said, we're monopolizing the conversation, probably because we're all in studio here. Mr. Rhodes, you need to join us next week. But what are your thoughts here for our friend, Mr. Dr. Larry, with his epic question?
Well, no, I agree with you guys. I think the better use of leaps is in the money for a longer term, long or short position, as opposed to something like that where it's out of the money and it's just grinding against you. And then even if you get half the price move that might put these things in the money, you get no benefit whatsoever, or you don't get the kind of benefit that you're hoping for. So I'm totally on board with what you guys are saying. I'm one of the things that we do in the class that I'm doing today is the students all give me 1 or 2 market scenarios and different time frames as well. And I'll use leaps based on their outlooks every once in a while, but I've never used an out-of-the-money leap in anything that I've ever created.
Yeah,
an out-of-the-money long leap. And on the other side of that, you don't really get much of a time decay benefit from them either. So I guess I'm just sitting here saying don't ever trade out-of-the-money leaps, which probably shouldn't say since I work for an exchange.
I like them for calls in some of these FANG names. They can work where the upside volatility can get kind of screwy. There can be something there. But, yeah, Russell, I think that especially in the big indexes, they've become such big banks dump money into them just so that they can report to Dodd-Frank that they've got all this risk, that they don't have risk on their sheets. As I look at those, if you're going to use them for hedge, I like put spreads would be an alternative. That would be cheaper. Or even like bear 1x2s. Bear 1x2s to get into stocks using leaps can be really interesting. You can take in some massive credits. So I like the leaps for trading skew a lot more than I like them for trading as a hedge or trading volatility.
That's a good point. If you're playing out there in those deep leap waters as a retail guy, you're playing with some deep
leap waters.
Leap waters, yes. Every insurance company and everyone else out there is just bidding all that stuff up ahead of you. So you're not. It's not like it's cheap out there, not just from a time perspective, but also from a volatility premium. They're going to bid those puts up. So you're paying. You're riding their coattails, and you're paying a commensurate premium for them. So I'm not. Yeah, leaps can work, but I don't think anyone here is overly enthusiastic about the leaps component. One of the best comparisons I saw of efficacy of puts goes back a couple of years ago, actually. I think it was the folks over at OCC. They did a study on collars, and they were constructing them in a variety of different ways. Obviously, they're trying to appeal to the asset management community and financial advisors, so they were looking at it from that perspective, and they were looking at all kinds of different things they were measuring, not just the theta decay, obviously, but also the management impact adjustments, efficacy in terms of hedging and everything else, and they tended to come down from their data around that 6-month level. I tend to like that time frame as well. On the put side, it's kind of the bit of the Goldilocks between it's not too close to front months, you're not just buying decay, and it's not too far out where you're paying excessive time premium for nothing, and it's not going to give you a lot of bang for your buck. So maybe look in that time frame. That would certainly cut down your outlay tremendously, and particularly if you start adding some of these short legs we're talking about here, that could maybe juice things up entirely. But again, if you love the leaps, go for it. If it's working for you, not my vehicle of choice. All right, moving on. We got a question here. Jay O'Neill. He or she writing, this is actually an interesting one. This might pique your interest as well. He says, I heard someone talking about the VVIX to VIX ratio. Didn't make much sense to me. Is that something you guys track?
Somebody brought that up to me, and I made fun of them.
I forgot who the hell it was. Maybe you were tweeting. Maybe that's where I saw it. But I was like, is this a thing? This is not a thing. What is this?
Yeah, you know who did that was our friend Kelly Boss.
That's where it came from.
At Tab Group. And I said, that's not a thing.
Yeah, because it's not a thing. Have I been missing this ratio all this time?
I said that's not a thing.
You can plot them on a graph. They do make points, but it's not a thing.
I mean, think about this. VIX is the cash index that tracks S&P, and VVIX tracks options on the futures. It's not a thing.
Yeah, so apparently our friend here has heard this now too, and he's asking if that's a thing. I don't think it's a thing. It's not a thing to me. It's not a thing. I don't know, Mr. Russell. We'll make you the arbiter. Is this a thing?
It's not a thing, but it could be a thing.
Why could it be a thing?
I'm gonna see her next week, and I'll talk to her about it. I'll report back. How's that?
I'm a big fan.
Is she responsible for putting this out there?
No, she and I were DMing about it. She and I were talking about it. She retweeted somebody about it and was like, "Wow, I didn't know that."
Those tab guys mixing it up, creating their own ratios.
She didn't create it. She heard it from somebody who puts themselves.
The same person Jay O'Neill heard it from.
Who puts themselves out there as an authority that clearly should not be, and then I was just trying to help her understand that that's not a thing.
Yeah, no, not. I think 3 votes, not a thing. That's about as definitive of a volatility panel as you can get, and it's not a thing. Let's see, we got time for one.
Let me just.
You want to do your Goldman?
Let me ask you what you think about this Goldman thing.
We run it down for our listeners first.
So there's some news out this week that it was a big deal on the Wall Street Journal. And it was that Goldman is giving out its secret sauce on trading to its top clients, all right, to bolster trading revenue. And my question is Goldman, and this will be to my 2 cohorts. 1, is Goldman giving out its secret sauce because, one, it doesn't work, or two, they've got new secret sauce that trades off the old secret sauce, or three, they actually think that this will produce more revenue for them in trading commissions than they can make trading the secret sauce.
Or
four, they legitimately just want what's best for their customers.
This show brought to you by Goldman Sachs, so I should. No, I'm just kidding. This is kind of thing we joked about before with the research papers and them talking up WTI puts back in the day, which eventually worked out. Not initially, but eventually it did. Just from a net delta perspective. I don't think in the time frame they recommended, but they've been known. All big houses have been known to, shall we say, talk up their books in the past. I would be. If Goldman turned to me and said, "Here's this great algo that prints money, and we're going to give it to you or sell it to you for a song," I would probably be dubious of the efficacy of that algo, or in this case, their quote unquote secret sauce. I haven't had a chance to read the article yet, but I'm looking at it now. But that's just the diehard trading cynic in me.
I'll tell you, my guess is that they've decided that they've got something else that works better, or they're not giving up everything. Here's a tip. I'm going to give a huge tip to everybody out there. All right. If somebody is advertising a trading system that makes lots and lots of money, or will make you lots and lots of money, all right, it probably doesn't work, because otherwise they would not tell you about it and they would do it themselves. All right. So like at Option Pit, we teach people how to trade. You'll notice we don't say, "I'll teach you what I do in my hedge fund," because my goal of my hedge fund is to make money. So the fewer people doing it, the more opportunity there is for me and my clients. And thus, that is how these type of things work. So my only thought is that Goldman stopped making the kind of money that they wanted to make on this, and have decided that they could make more money in terms of client acquisition releasing this than they can ever make
even
trading
if it did work, even if it was the secret sauce. Once 2 or 3 clients get a hold of it, they're going to milk it dry instantly, and whoever comes on later is not going to be as good. So whatever trade was there, if it is, they don't say which system it is, but whatever trade was there will be mined thoroughly in a very short order. Speaking of short order, we got short order left to go on the show, so let's dive right on into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
How many times have I said that? Mark just said to me, his listeners in the studio, I was perfect in my prediction until yesterday. How many times have I said that on this show? I was super close until about 8 a.m. this morning, and then my prediction just pooped the bed, as they like to say. Of course, crystal ball, this is the portion of the show where we prognosticate wildly, some may say recklessly, some may say embarrassingly, the future of volatility. Again, we got to do it for the whole week, so we're trying to predict where it is this time, end of the show next week. All of us leaning lower. Russell was, at the time, the seeming bull of the group. He picked a whopping 12.99, so he was flirting with the 13 handle. Mark was hovering around 12.5. I was fading things to the downside, about 11.75. All of us just blown out of the water today as we're closing the show. VIX Cash up about almost 3.5 handles, nearly 16 handle right now.
Yeah, it's over 16 now.
Oh yeah, just printed over 16.
16 and a quarter.
So yeah, all of us even our most optimistic prediction is over 3 handles off. So let's go for the least loser, which is Russell. He gets the opportunity. Do you want to go first, or do you want to pick who goes first?
I'm going to pick who goes first.
All right, go for it, sir.
All right, I'm going to pick Mark.
Just for that clever witticism. I should make you go first. But no, I will go first. I will take the bullet. I actually kind of like going first, because it lets you set, otherwise you have to kind of squeeze in between everyone else, and it's no fun. All right, let's go here. So I was fading it last week. Again, we got stuff coming up on Monday, so that's going to be a deciding factor. I'm clearly going to say we're not going to be, I don't think, here for too long. I'm going to think we're going to go back I'm going to say about, I'll be optimistic, but not super optimistic. I'm going to say 14.5. There we go. Mr. Other Mark. What say you, sir?
All right. Well, I think that what'll be interesting is that next week we'll see an 18 handle and we'll see a 13 handle. I'm going to go 13.
13, huh? All right, so the other mark.
But we'll see an 18.
Mark
but we
the
will,
lesser. 13,
we will see an 18
13
or an,
even,
or
you said?
13 even. I think we'll see an 18 or a 19 handle next week, though.
That wouldn't surprise me at all. If we wagered on the range of VIX, that would be a different story. All right, Mr. Rhodes, take it home. Where are you feeling? You feeling 18? You feeling your oats?
I'm feeling my oats, and I'm going to tell you why, and then you guys don't get to change your guesses. The next Fed meeting is September 21st, so that'll be the next Friday is the last Friday before the next Fed meeting. So I actually think we'll be up around 17.
There you go. The diehard VIX
And
buyer.
I'm not, and normally when I say things like that, I'm kidding. I'm actually not joking around. I'm pretty serious. I seriously think that higher volatility is here probably through the end of the year at this point.
Well, that certainly would be a good thing. For you folks over there. And I definitely don't disagree. We do need a little bit of vol back in the marketplace. Whether it's this much this soon, we shall see. But we did. You can't stay at an H vol of 5 forever. You got to go somewhere from there, preferably not down. And we did not. We went up. So that is interesting. We shall see how that plays out next week. Who is the most embarrassed? Meanwhile, though, that music means it's time to bring this epic volatility journey to a close. What a journey it's been. Talking VIX futures, VIX cash, VIX options, a little bit of crude, some guesses out there in crude VIXs. Your epic questions, keep them coming. We didn't even really scratch the surface. We got so many more to get to. We'll get to more next week, don't worry. But before we go, let me check back in with each of my cohorts, my partners in crime. Let's start with you, Mr. Corner Office. What's cooking in the land of all things CBOE live vol?
Well, next week we're doing a all-day class on income trading, which is kind of funny since the that would have made sense about a month ago, and now we probably should change the class to speculative trading or for volatility events. But we're doing that, and then we've got risk management coming up, which the last week of this month, and I made sure that I will be back in the United States by Friday to report back about all things risk management in Europe.
It's a shame I'm going to be missing that one, but that is indeed not that long from now, actually, in Dublin. It's Dublin this year, right? Again, is it Dublin again, Russell?
Yes, it is in Dublin again. And it's last year it was Portugal. This year it's Dublin. I think we're going back and forth between countries that have bordered on bankruptcy in the past.
If you get back to Sintra, let me know. I was upset that I missed that one. I love that part of the world. I'll certainly maybe try to head back for that one. So check it out. If you do want to attend, listeners, head on over to CBOE. Just search for RMC, CBOE RMC, and that will take you to the conference page. And of course, before we go, Mr. Greasiest of Meatballs, you get my chair all greasy here. What's cooking in the land of the pit, as well as Carmen Line?
Hey, we just pushed out a VIX ebook last week, and I sent Mark a link to go download it. You can it'll be in the show notes. So download my new VIX ebook and enjoy reading all the things you need to know about the fear gauge.
There you go, listeners. We'll put the link in the show notes, or you can find it over there at Option Pit. Is there a cost for this? Is it free? Free? Oh, there you go. Free ebook, listeners. So check it out. If you listen to the show, I'm guessing you like all things VIX, and you could read the musings of the greasiest of greasy meatballs completely for free. And on behalf of the aforementioned Greasy Meatball and Mr. Corner Office, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing. Of course, for all of you who tuned in live, we love you guys too. We'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/The Options Insider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.